I want to talk a little bit about valuations. Specifically, what I want to talk about today is something that I saw on Joseph Carlson's show. Um, he talked about the way that he values stocks. And I, for a long time, felt like he had a tendency to overpay uh, for the stocks that he was buying. Um, and that he was sort of accepting a pretty average return, which there's nothing wrong with that. If you're accepting a pretty average return, you're probably gonna beat most investors out there, right? Um, and that's sort of where it stops. So I want to take a little bit of time and talk about his methodology um, for doing those valuations. So he's looking at two numbers specifically, and he's looking at a third implicit number, and from those numbers he's deriving price to earnings ratio, and then he's applying that price to earnings ratio to his favorite stocks, and that's where he's getting his valuation from. So the two numbers that he's looking at are return on capital employed and percentage of earnings growth. That's actually pretty decent. I've got no complaints about those. I sort of wrap both of those numbers into my growth rates when I'm doing my discounted cash flow model. That's fine, right? He's basically splitting that growth rate out from natural growth and growth from investment, and to derive something akin to a overall growth rate, which is absolutely fine. It makes a lot of sense to do that. I can't fault him for that, actually. He's using a third implicit number, though, and that implicit number is the cost of capital. And he assumes an 8% cost of capital, and he's using that to derive what the optimal price to earnings ratio that should imply. And, he's coming up with numbers like, for a good company with a good return on capital employed with decent earnings growth, you'd see something like a 22 to 24 times multiple on earnings, which makes a lot of sense to me, especially when I'm looking at this. Here's the thing. I've always said that if you want fair value, you need to look at a company's weighted average cost of capital, right? Which he's basically assuming for all companies is 8%. And you use that weighted average cost of capital as the way to calculate the fair value of a company. And as you use that as the discount rate. What we see Joseph Carlson do is he's using that 8% number. So that's basically equivalent to the way that I calculate free cash flow. I use my discounted free cash flow models, except for instead of using the 15% standard discount rate that I personally use, he's using an 8%. And because he's using an 8%, he gets higher valuations than I do. After I saw the way that he calculates his fair value estimates and what he's willing to pay for these stocks, I respect his numbers. I respect them a lot. I think that it is a reasonable way that he is valuing his stocks. It's not personally my cup of tea, but it makes sense, right? Joseph Carlson's valuation model is reasonable, right? And reasonable people can disagree about how to value a company. And that's sort of where I sit right now with him, and the way that I'm seeing how he's valuing his stocks. I think that he's got a reasonable methodology. I think that that's going to get him an 8% return, which is actually a pretty decent rate of return. It's sort of market matching returns. Um, it's not horrible, right? And here's the thing. Um, that's just telling him when it's okay to buy. It doesn't necessarily mean that's when he's going to buy. You look at his undervalued numbers, and they're pretty decently low. He's probably going to get somewhere in the range of a 10 to 12% return based off of what I'm seeing with those undervalued numbers. So if he's buying when the stock is undervalued, according to his model, he's going to do okay. He's going to do just fine. Um, and I think that's fair. I think it's completely fair to sort of do your valuation like that. I personally don't like that sort of methodology. It makes sense, right? You want to look at your cost of capital. You want to look at your uh, returns on capital employed to determine whether or not you're creating or destroying value. I look at those as metrics for how well management does, right? And whether or not they're a good pick to put money into. Um, so I don't fault him, right? They're creating value, and that seems to be really important to him. Is this company creating value or destroying value? And then he makes the point that if you're growing earnings rapidly, but you're destroying value, you're going to be destroying value faster and faster and faster. And so you don't want earnings growth, right? What you want is you don't want that company investing. What you want that company to do is pay a big fat dividend, right? We earn money, and instead of destroying that value, we give that value to you as a shareholder, right? And I'm okay owning those things, right? If the company understands what's going on, right? So his valuation methodology makes sense, is I guess what I'm trying to say, is that I've never been one to really look at the earnings necessarily and apply earnings multiples like that. But the way that he's coming up with those earnings multiples is very much like a discounted cash flow model anyway. So it's fine. And if he's pulling those numbers up, and guess what? When I plug in 8% into my discounted cash flow models, I get something very similar to what he's getting in terms of value for the stock, right? The intrinsic value of the stock. And that's probably an accurate statement, to be honest with you. Again, I'm not trying to get a fair price for the stock. I'm trying to get a price that's below its intrinsic value, significantly below, to the point that I'm getting a 15% return, whether or not that company is creating or destroying value, right? The price you pay actually matters a great deal for where you're going to end up. He makes a good point, though, in his video, right? And that is, if you're buying companies that are creating value through their investments, and they've got a long runway on those investments, and they can continue making those investments, that company is going to do very, very well over time. I can't disagree with that. The fundamentals of your company are going to get better and better and better. And that is a good thing to do when you're an investor, right? That is something that you want to look for. However, you don't want to pay too much for that. And I think that you'll get a better deal if you're patiently waiting for dips along the way and buying those dips. Now, how much you're willing to pay that's a discussion for you, right? That's a number for you, right? How much are you trying to achieve? So anyway, take that for what it's worth. Today was very much a just here's what's happening with the valuations according to Joseph Carlson. He's showing that a lot of his stocks are undervalued according to his valuation model. And frankly, if you're assuming an 8% weighted average cost of capital, they are undervalued. And yeah, at that point, it's not a matter of how much, right? The question isn't whether or not you should. The question becomes more of how much are you going to get, right? And are you okay with that? So that's the way I view his valuation models. I think they make sense. And we'll talk to you again later. Until then, stay rational, my friends.